Welcome to The Explainer. I am so incredibly thrilled you're joining me today because, wow, do we have a fascinating and honestly pretty bumpy market session to unpack. We are diving deep into the broad-based market sell-off from April 30th, 2026. So if you've been glued to the ticker today, just scratching your head and wondering what on earth happened out there, you are exactly in the right place. We're going to break down the charts, the big global catalysts, and the specific corporate earnings that really drove the day's action, and we're going straight to the data to do it.
But hey, really quick before we jump into the deep end, just a standard but super important reminder. Everything we're discussing in this explainer is strictly for educational purposes, okay? This is definitely not investment advice. Our whole goal here is just to empower you with the framework to understand these crazy market movements. Oh, and a huge shout out to our data backbone for today's analysis. Every single figure and chart we're looking at is sourced directly from the BSC, NSE, and MCX.
All right, let's get into it. 180. Just let that number sink in for a second. That is the exact number that completely set the tone for the entire trading session. The Nifty didn't just open a little lower today, it literally dropped like a stone with a massive 180-point gap down right at the opening bell. When you see a gap down of that sheer magnitude, it instantly tells you that some major overnight developments forced the market to brutally reprice risk before regular trading even started. So, moving right along to Section 1, the Nifty Sell-Off Explained. Let's really look at the anatomy of today's battle between the bulls and the bears. Now, what's absolutely fascinating here is how clearly the day's psychological tug-of-war played out. Just look at the far left of the chart. There is that painful 180-point gap down, opening the index at 23,997. And the bleeding didn't stop there. Within the first hour, fear totally took the wheel, dragging the Nifty all the way down toward that critical 23,800 to 23,850 zone. For the rest of the morning, we basically just chopped sideways. Buyers were terrified to step in. But then, notice the shift right after noon. Buying interest finally ignited, and we saw this steady, almost stubborn recovery rally. The index fought its way back to actually reclaim 24,050 by 2 p.m., right before a final hour pullback saw it settle at 23,997.55. That's a drop of 0.74% for the day. Talk about a dramatic round trip, right? But listen, please don't let that afternoon recovery trick you into thinking everything is sunshine and rainbows. The really crucial point here is the market breadth. Even though the chart bounced back, look at the internal numbers. We had only 140 stocks advancing against a massive 359 declining. That's an extremely weak advanced decline ratio of 0.39. Sellers were literally everywhere across the board. Plus, the India VIX, the market's fear gauge, shot up by nearly 6% to 1846. So that tells us that, bubbling underneath that afternoon bounce, elevated nervousness and anxiety are still very much sitting in the driver's seat. Which brings us to a really important question. While equities bled out, where exactly did the smart money hide? Let's get into Section 2, Global Triggers and Commodities. You see, whenever risk assets like equities take a beating across the board like this, capital doesn't just evaporate into thin air, it rotates. And today, we saw a textbook flight to safety. Capital aggressively rotated right out of the stock market and flooded directly into safe haven commodities. It was basically a mad dash for the exits. Now, the MCX Commodities Board captures that panic so perfectly. Just look at those top two lines. Gold jumped an impressive 1.81%, pushing past 1,51,000 per 10 grams. But silver? Oh man, silver absolutely soared, rallying nearly 3% in a single day. When precious metals are spiking this violently while the Nifty is gapping down, the market is practically screaming that it is deeply worried about global stability. So, what exactly had everyone so spooked today? Well, we can trace this panic back to a perfect macroeconomic storm made up of three key suspects. First up, severe geopolitical tensions. We had reports swirling about potential U.S. military action in Iran, which instantly rattled global nerves. Second, as a direct result of that Middle East tension, Brent crude spiked to its highest level since June 2022. And for a net energy importer like India, surging oil prices are a massive headwind for inflation and growth. And third, the U.S. Federal Reserve maintained a highly hawkish stance, holding interest rates steady at 3.50% to 3.75% while signaling they won't be cutting rates anytime soon. High oil, war fears, tight money, it's literally the exact recipe for a massive equity sell-off.
Okay, bringing it back to domestic shores now. Section 3, Sector Scorecard and Stocks. Let's see exactly which parts of the Indian market absorbed the heaviest blows today.
I always say that the sector heat map tells the truest story of the day's sentiment, and today, well, that story is painted bright red. Out of 12 major sectoral indices, 10 bled out today. It was a merciless, broad-based hammering. The absolute only places investors found any shelter at all were IT and pharma, which barely, and I mean barely, managed to keep their heads above water, eking out gains of 0.37% and 0.03%. Literally everything else was dragged down.
And the damage was super concentrated in those high-beta, economically sensitive sectors. Nifty Metal just completely collapsed, shedding 2.12%, Nifty PSU Banks slid 1.68%, and Nifty Realty dropped 1.50%. When you see these specific sectors taking the hardest hits, it really confirms that investors are aggressively pulling risk off the table. They're anticipating that higher energy costs and global uncertainty might seriously slow down infrastructure and banking momentum.
To really understand the underlying health of the market, we have to look under the hood. So let's move to Section 4, the Corporate India Checkup, focusing on Q4 earnings. You know, earnings season always provides such crucial nuance, and today was definitely no exception. We saw Adani Ports report a really solid 9% year-over-year jump in net profit, totally driven by strong cargo volumes. However, its sister company, Adani Enterprises, actually reported a net loss of 221 crore. They were heavily impacted by higher depreciation from new assets, even though their core revenue rose 20%. But honestly, the most fascinating story for me was Hindustan Unilever. HUL actually posted a massive 21% rise in net profit. Now, you would think the stock would soar on that news, right? Nope. Instead, shares fell over 2.5%. Why? Because management announced 2 to 5% price hikes to offset rising input costs, and the market immediately panicked about future margin pressures and a potential demand slowdown. Remember, the market isn't looking at today, it's always looking 6 months ahead.
And speaking of looking ahead, there is a growing, very loud conversation globally about tech valuations. Richard Harris, the CEO of Port Shelter Investment Management, warned that market valuations in the AI sector may be running way ahead of actual earnings growth. Put that right alongside the Fed's refusal to cut rates until inflation drops, and there is a clear warning flashing here that the speculative froth around artificial intelligence globally might be due for a harsh reality check.
But hey, there's a really fascinating duality happening here. While global macro analysts are wringing their hands over AI valuations being too high, the actual practical application of AI is quietly transforming bottom lines right here in India. Sudipta Roy, the MD and CEO of L&T Finance, dropped this incredible nugget today. He said, "We're looking at about an Rs 30 to 40 crore cost save just in collections this year due to collection AI bot calls." So the crucial takeaway here is that while the stock hype might be overpriced, the actual technology is already doing the heavy lifting and creating immense corporate efficiency on the ground right now. Okay, we have covered the past and the present. Now let's look at the future. Section 5. Decoding the options data. Where exactly does the smart money think the Nifty is heading next? Now, if you're a bit newer to options data, don't worry, let me briefly demystify open interest, or OI, for you. It's actually pretty simple once you get the hang of it. Think of it like this. An increase in call open interest generally indicates resistance. Basically, these are sellers defending a price ceiling in a falling market. Conversely, an increase in put open interest indicates support. These are the buyers defending a price floor. By looking at where these giant towers of OI are built, we can actually see the market's boundaries. So let's apply that directly to today's data for the Nifty contracts expiring May 5th. Look at the massive red bars on the right side of this chart. That is huge call open interest building up right at the 24,500 level and secondarily at 24,300. The sellers have firmly planted their flags there. On the flip side, the green bars show that maximum put open interest is clustered much lower down, primarily at 24,000, with backup support clearly visible at 23,800 and 23,500. So what does this actually mean for you? Well, it gives us a really clear technical map for the immediate future. The options data is loudly telling us that the Nifty is boxed in right now. We're looking at really heavy resistance overhead between 24,400 and 24,500. Breaking above that ceiling is going to take a massive positive catalyst. On the downside, we have strong, heavily defended support between 23,700 and 23,800. For now, it looks like the market is preparing to just battle it out within this specific range. Which leaves us with this final thought. We've got a rising VIX, serious geopolitical tensions, high oil prices, and major state election results looming right around the corner. Considering all the facts we've unpacked today, are the institutional sellers who drove that massive gap down pricing in the absolute worst-case scenario right now? Or is today's 180-point drop just a minor tremor before the real volatility begins? Think about that as you watch the open tomorrow. Thank you so much for learning with me today on The Explainer. Stay focused, stay curious, and I'll see you next time.